20 din mein paisa double is a famous line from the Bollywood movie Phir Hera Pheri, which many of you might recognize. When it comes to investment, there are often misunderstandings like you can get double the amount you have invested in 20 to 30 days. The first misconception is viewing it as a quick way to make money. The second is believing that mutual funds are solely linked to the stock market, and if stocks crash, all your investments will be lost. In this episode, I aim to debunk these misconceptions and shed light on what mutual funds truly entail. It will help you grasp why mutual funds are becoming a preferred investment choice for many. Mutual funds are investment vehicles where an asset management company, AMC, pools money from various investors and invests it in a variety of assets, including bonds, stocks, and other securities. The AMC employs professional fund managers to handle this pooled capital. These experts form a team responsible for thorough research and selecting funds that aim to offer investors higher returns while managing risks. The value of a mutual fund is represented by its net asset value, NAV, calculated by dividing the total value of all assets and securities held by the fund by the total number of outstanding shares. The NAV indicates per share value of the mutual fund and helps investors assess their investment's worth. To simplify, imagine planning a summer vacation to the mountains with your family. You have two options: drive yourself in your car or take a bus with other passengers. The first option, akin to investing in the stock market, requires you to have a good car, ample funds for different stocks, be a skilled driver, knowledgeable about the stock market, and have familiarity with mountain roads, expert guidance. The second option mirrors mutual funds, where you travel by bus with others, and the responsibility of reaching your destination is not solely on you. If you can't invest a large sum upfront, buy expensive stocks in big companies, you can invest in a mutual fund where many others pool their money. A professional fund manager, like a bus driver, navigates your investments toward your financial goals. In this analogy, the bus company retains a profit margin covering the driver's salary. Similarly, the AMC, Asset Management Company, keeps a portion of your invested money to pay fund manager's salary. The expense ratio, typically between 1% to 3%, is reasonable. SEBI, Securities and Exchange Board of India, under the Ministry of Finance, Government of India, regulates all AMCs, ensuring responsible investment and rule compliance. This demonstrates that mutual funds are legitimate and not a Ponzi scheme. SEBI has categorized mutual funds into 5 types in India. 1. Equity mutual funds. These primarily invest in stocks, offering potential higher returns but with increased risk. 2. Debt mutual funds. Here, funds are invested in debt, providing lower risk since stock market fluctuations have minimal impact. 3. Hybrid mutual funds. Combining both equity and debt investments, balancing risk and returns. 4. Solution-oriented mutual funds. Designed for specific goals like child education mutual funds. 5. Other mutual funds. Funds invested directly in indexes or in funds of funds. This dispels the misconception that mutual funds are no different from stock market. While mutual funds may offer slightly lower returns than stocks, they are less risky. Different mutual funds align with various investor goals. Some prioritize minimal risk over high returns, while others seek better returns, willing to accept higher risk. With 44 asset management companies, AMCs, in India and over 2,500 mutual fund schemes, investors can find options take tolerance.